Hello traders, welcome back. Michael Harding here from the Academy of Financial Markets. In this lecture I'll explain the difference between trading the majors, minors, and exotics. Now the majors are all made up of the US dollar on either the base side or on the quote side. Okay, so these are all of the major pairs. Minors do not contain the US dollar. Okay, so it's anything from Euro Pound to CAD Yen. And exotics are currency pairs that contain a major and they're matched with the currency of an emerging or a strong but small economy from a global perspective, such as Hong Kong or Singapore and European countries outside of the Eurozone. For example, Euro Turkish Lira, or the US dollar versus the Hong Kong dollar. Now, the difference between trading majors, minors, and exotics, it's mostly the pip spread. So if we take a look at USD Yen, the pip spread here is about 2 pips. Okay? And let's take a look at a minor. So CAD Yen, the pip spread here is about 3 or 4 pips, give or take. And an exotic, like the Euro Lira, the pip spread is, it's about 16 pips. Okay, so this is something that you guys have to pay attention to because there's a larger buy-in commission required to trade an exotic versus a major and a minor. Okay, so for example, if I were to trade USD Yen, and just pay attention to the terminal down below. So if I bought this, the pip spread is 2 pips. So if I bought one standard lot, oops, sorry about that. Let me just do that again. So if I buy one standard lot, it costed me about 20 bucks. So I was negative $20 the moment I entered the trade. Now, if I were to trade the Euro Lira, just pay attention to my terminal down below, just buy this. You see, that costed me about $60. Okay, so it's a lot more expensive to trade an exotic versus a major or a minor. Okay? So that sums up for this lecture. In the next lecture, I'll explain the difference between trading gold versus oil.